there, tax accountants. I hope all is well, and I pray that as you're viewing this video that you're in the best of health and spirit. This video will cover several questions from Chapter 3, Tax Credits, so we'll jump right in. The 2023 child tax credit is not available for children ages 17 or older. Is this true or false? So as we learn with the child tax credit, this is actually true. To qualify for the child tax credit, the child must be under the age of 17. So this is true. And just a few more things as it relates to the child tax credit. So with the child tax credit, we know that this essentially permits individuals to take tax credits based on the number of their qualifying dependent children. And again, some of the requirements: the child must be under the age of 17, they must be a U.S. citizen or resident alien, they must be claimed as a dependent on the taxpayer's return, and they must meet the definition of a qualifying child. This question states, what are the adoption credits for both 2022 and 2023, respectively? In connection with the adoption of an eligible child who is a U.S. citizen and who is not a child with special needs, Sean pays $4,000 of qualified adoption expenses in 2022 and $3,000 of qualified adoption expenses in 2023. The adoption is finalized in 2023. There is no phase out of the adoption credit. What are the adoption credits? So we know taxpayers, they're allowed 2 tax breaks for adoption expenses. The tax credit is allowed for qualified adoption expenses paid by the taxpayer, and in the event that, let's say, there's an exclusion from their W-2 income if a portion of it is paid by their employers. The credit is allowed for the tax year that follows the year during which the expenses are paid or incurred, unless the expenses are paid or incurred in the year that the adoption becomes final. So with these adoption expenses, Form 8839 is used to calculate the amount. And we know that there's a limitation. Sometimes there's a phase out and things of this nature, but this lets us know there's no phase out. So based on this information, the correct answer is 0. So 0 for 2022, and in 2023, Sean claims rather the $4,000 for 2022 plus the $3,000 for the adoption expenses in 2023. So therefore, D is the correct answer. 0 would be reported in 2022, and in 2023, $7,000 would be claimed. This question asks, what is the purpose of the low-income retirement plan contribution credit? So with the low-income retirement plan contribution credit, again, the key thing with this is to encourage individuals to set aside money for retirement. So that is one of the main things. There's certain low-income taxpayers that they can claim a non-refundable low-income retirement plan credit. And this is often referred to as the saver's credit. And again, the key thing is to kind of encourage them to participate in tax-saving retirement plans. The credit rate, as we know, it could be 50%, 20%, 10%. It ultimately depends on the taxpayer's filing status as well as their adjusted gross income. So we go through these. A, is it to increase the amount of the taxpayer's Social Security benefits? No. Is it to encourage taxpayers to participate in retirement plans? B seems correct, but we'll look at the others. C, to encourage employers to match employee contributions to our 401k? No. Is it to increase the amount that employers can put in employee pension plans? No. So B is our correct answer, to encourage taxpayers to participate in retirement plans. This question asks, which of the following taxpayers qualifies for the earned income credit in 2023? So here we have, different answer choices. We have a 16-year-old, we have a 22-year-old, we have a 70-year-old. One of the key things with the earned income credit, it's available to qualifying individuals that have earned income in AGI below a certain level. And one of the main reasons, the purposes For this credit, it essentially helps to assist the working poor by reducing their tax burden and helping to supplement wage income through a refundable credit. So here we have a 16-year-old high school student who earns $8,000 at a part-time job. Next, we have a 22-year-old single college student who can be claimed as a dependent by their parents. Next, we have a 70-year-old taxpayer with only Social Security income. Then we have a single 31-year-old construction worker with 22,000 of AGI and 2 children. So the correct answer would be D, a single 31 construction worker. So we'll go through them. So a 16-year-old high school student who earns $8,000. So again, now we got to think back to the rules, right? With the rules, we know that there are 7 rules that must be met. There's a AGI limit. They must have Social Security numbers. Based on married filing separate, they can't file a return. There's earned income requirement and things of that nature. So this 22-year-old, they can't be claimed because they're a dependent of their parents. This 70-year-old cannot claim EITC because they don't have any earned income. And the 16-year-old, yes, they earn $8,000 at a part-time job, but they're still considered a dependent. So therefore, D, the single 31-year-old construction worker with $22,000 of adjusted gross income and 2 children would be eligible to claim the earned income credit. Next, this question asks, how much is the refundable portion of the child tax credit for a taxpayer with 1 or 2 eligible children? So as it relates to the child tax credit, we know that there's a refundable portion and there's also a non-refundable portion. And it's the non-refundable portion is ultimately reflected on Form 8812. So in order to determine the amount, the non-refundable portion of the child tax credit, it's limited to the amount of tax liability before taking the child tax credit. Keep in mind, there might be some other credits and it's the pecking order and things of that nature. And in order for us to determine the amount, the correct answer is as follows. It's the lesser of $1,600 per child or 15% of the taxpayer's earned income over $2,500. So just keep that in mind. It's the lesser of, not the greater of. So we have the correct numbers. B and D would be incorrect, right? The numbers are incorrect. It's the lesser of $1,600 per child or 15% of the taxpayer's earned income over $2,500. And one of the great things is when you prepare a tax return, you know, the tax software is automatically going to factor in these rules, but it helps to know them for tax planning. And in the event that a client has a question, you definitely want to be able to explain to them what the rules are. Same vein, child tax credit. Here it's asking which of the following will qualify for the child tax credit of $2,000 in 2023. We have a dependent child age 21 and a full-time student. We have a dependent child age 17. We have a dependent parent age 67 that lives with the taxpayer. And we have a dependent child age 13. So keep in mind, you might say, hey, wait, dependent child age 17. One of the key things is that the child must be under the age of 17. It doesn't say 17 or under, but based on the rules, they must be under 17. So based on this fact pattern, A, child is 21, doesn't qualify. B, 17, doesn't qualify. C, a dependent parent, doesn't qualify. D is our correct answer, a dependent child that is age 13. For this question, it asks, which of the following best describes the other dependent care credit? So sometimes you might have a qualifying child, as we learned about dependents, or you might have what's called a qualifying relative. So qualifying relatives, they are eligible for the other dependent care credit. And with the other dependent care credit, fairly straightforward. This is basically $500 for dependents that don't qualify for the child tax credit. So we go through the answer choices. A non-refundable credit based on a percentage of income. No. B, a credit for a percentage of the expenses paid for child or dependent care? No. That would be the child and dependent care credit. A, a $500 credit for a dependent that does not qualify for the child tax credit. This seems to be the correct answer, but we'll also look at D. D states a $2,000 credit available to taxpayers with AGI under certain limits and children under 17. This is the child tax credit. But the question is asking about the other dependent credit. So C is the correct answer. A $500 credit for a dependent that does not qualify for the child tax credit. This brings us to our next question, and we move on to education tax credits. It says, assuming there is no phase out of the credit, his lifetime learning credit for 2023 is, in 2023, Sam pays $1,100 to take a course to improve his job skills to qualify for a new position at work. Assuming there's no phase out, what's the lifetime learning credit? So, fairly simple. In this case, we see that he paid $1,100, and we know that with the lifetime learning credit, taxpayers, they can elect a non-refundable tax credit up to 10%, and there's a statutory percentage. The lifetime learning credit, it's available for qualified expenses paid for education of a taxpayer, but this also extends to their spouse and their dependents. This credit is also available for undergraduate, graduate, or professional courses. So something to keep in mind. So the maximum amount is $1,100, and the statutory percentage for 2023 is 20%. So $1,100 multiplied by 20%. In such case, Sam is able to claim a lifetime learning credit of $220. Again, how did we get that? The maximum qualified expenses up to $10,000. Sam only paid $1,100, so $1,100 multiplied by the statutory percentage of 20%. That is how we calculated the credit of $220. Here we have this question about the low income retirement plan contribution credit. So it's asking us, what is the savers credit Virginia and Richard will be eligible for? Virginia and Richard are married taxpayers with an adjusted gross income of $43,000 in 2023. If Virginia is able to make a $1,500 contribution to her IRA and Richard makes a $1,500 contribution to his IRA, what is the savers credit that they'll be eligible for? So as we know, the purpose of this low income retirement plan contribution credit, or referred to as the savers credit, this helps to encourage individuals to participate in these tax saving retirement plans. The credit rate, it's either 50%, 20%, or 10%, depending on the taxpayer's filing status, as well as their adjusted gross income. And based on the combined adjusted gross income for Virginia and Richard, which is $43,000, their credit rate is 50%. So therefore, in order to calculate this, it will be $1,500, which was contributed for Richard, and $1,500, which was contributed for Virginia. So there's a total of $3,000. And because they get the credit rate of 50%, so I'll do that again, $1,500 for Virginia plus $1,500 for Richard, because their credit is 50%, they are eligible for a savers credit of $1,500. And again, the tax software will essentially automatically determine the amount, but you just want to be able to, notice information in case the client has any questions or if there needs to be any tax planning. For this next question, is asking us to calculate the total 2023 child and other dependent credit for the following. Here it states Jeremy is single, head of household, father with $80,100 of AGI and has a dependent 8-year-old son. So based on this, we know that the child tax credit, it's ultimately based on the Tax Cuts and Jobs Act. It was increased to $2,000 per child. Depending on the income, it might or might not phase out, but the threshold was increased. And then there's also an increase in the refundable amount of the credit. And we know that in order to qualify, the child must be under the age of 17. There must be a a U.S. citizen or a resident alien, they need to be claimed as a dependent, and they need to meet the definition of a qualifying child. So with this dependent son, doesn't give us any other fact pattern. So in such case, $2,000 would be allowed for Jeremy. For B, we have Jerry and Ann. They have $100,000 of AGI. They filed jointly, and they claim 2 dependent children. Preschool, they're under the age of 6. So in such case, these 2 children, they fall within the range. There's no phase out. So therefore, Jerry and Ann would be able to claim $4,000 for both children. So now, we have this example. Now we have James and Apple. They have AGI of $430,300. They filed jointly, and they claim 3 dependent children, 7, 10, and 19. So we know that the maximum credit is $2,000 per credit child. However, when we're dealing with married filing joint payers, the phase out begins when the adjusted gross income exceeds $200,000 for all other taxpayers, single, head of household, etc. And it phases out when adjusted gross income exceeds $400,000 for joint filers. And based on what we reviewed, the credit it's phased out by $50 for each $1,000 that exceeds the threshold, right? So in such case, we would calculate it as follows. We know that the threshold is 400,000, so 430,300. That's their AGI, and we know that the threshold is 400,000 for a married filing joint couple. So we see that there's $30,300 in excess. So the next thing that we need to do is we'll divide this by 1,000, and we get 30.3. And as per the IRS's instructions, this 30.3 would essentially be rounded up to $31. So again, because it's every 1,000 or part of 1,000. So basically, based on the instructions, they are, $31,000 in excess. So we round this up to 31 based on the IRS instructions, and it phases out for by $50 for every 1,000 or part thereof in excess. So 31 times 50 lets us know that there's going to be a reduction of $1,550. So from there, we ultimately need to determine how much is going to be phased out. So I'll do that again quickly. 430,300 minus the maximum threshold for married filing joint, which is 400,000. And again, it's reduced by $50 for every $1,000 or a part of $1,000. So we divide it by 1,000, we get 30.3. And again, because the IRS rules state that it is reduced by $50 for every 1,000 or part of 1,000, we round it up to 31. So 31 times the reduction per 1,000 or part 50, that lets us know that the total credit is going to be reduced by 1,550. So based on that, we see we have 2 children under the ages of 17, so we have 2,000 for the child that's age 7 plus 2,000 for the child that's age 10. And the child that is age 19, it doesn't tell us anything about them being in school, being a full-time student, so they would get the other credit of 500. So there's a total credit of 4,500. However, as we just calculated, there's a reduction of 1,550. Therefore, the maximum amount of the credit would be 2,950. This brings us to our next question. It asks, how does the earned income credit produce a negative income tax? So we know with the earned income credit, it's available again to qualifying individuals in order to help to assist them to reduce the tax burden. So in this case, most tax credits, they're limited to the amount of total tax liability. So let's say a client has a tax liability of $1,000 and they have a credit of 1,300. What happens is that their tax credit of 1,300 will totally wipe out their tax liability to zero, but they won't get that extra $300 if it's a non-refundable credit. But if it is a refundable credit, their tax liability, which is $1,000, and their tax credit, which is $1,300, they would now get a refund of $300. So it's very important to distinguish between refundable and non-refundable credits. So in this case, the EIC is considered a refundable credit. The earned income credit can produce a negative income tax because taxpayers who are eligible to claim the credit may only take a credit equal to the tax owed, no, receive a refund for the credit, even though the credit, I'm going to make this smaller, receive a refund for the credit, even though the credit exceeds the tax liability. This seems correct. It cannot receive a refund if no income tax was withheld, incorrect. Not receive a refund even if they're not required to file, no. So the correct answer is receive a refund for the credit, even though the credit exceeds their tax liability. Next, we see this question that asks the foreign tax deduction will result in a blank tax benefit, whereas claiming the foreign tax credit yields a blank tax benefit. Therefore, the taxpayers should. So we see Martha and Lou, they're married taxpayers with $400,000 of foreign tax withholding from dividends in a mutual fund. They have enough foreign income from the mutual fund to claim the full $400 as a foreign tax credit. Their tax bracket is 24%, and they itemize deductions should they claim the foreign tax credit or a deduction for foreign taxes on their Schedule A. So U.S. taxpayers, they are allowed to claim the foreign tax credit on income earned in a foreign country in consideration that the income earned in that country is also subjected to taxes. So one of the main reasons is to eliminate double taxation on income earned in a foreign country. Taxpayers, they could decide to make an annual election to claim a deduction instead of a credit. So one thing we know is that a credit is a direct reduction of tax liability, and a deduction reduces taxable income. And ultimately, depending on the situation, that kind of determines, what will work better in their favor. So if they took a deduction, again, with the deduction, it reduces the taxable income, and the benefit is going to be determined based on a tax bracket. So if they took a deduction, the credit is $400 and their tax bracket is 24%. So they would get a $96 tax benefit if they claimed it as a deduction, versus if they took the credit, they would be able to claim the full $400. So based on that, it would make the most sense for them to claim the foreign tax credit. So again, that's the key thing. Deductions reduce the taxable income, and the tax savings is ultimately depending on their tax bracket, which is 24%. So therefore, we multiplied the $400 deduction by the tax bracket, and that is how we yielded the 96%, versus if they took the credit, they would be eligible to claim the entire $400. Now we look at education credits. A asks, assuming Jasper has AGI of 86,000, how much lifetime learning credit can Jasper claim on his tax return? B, if Jasper were married and supporting a spouse who was not working, how much lifetime learning credit can Jasper claim? So in this case, Jasper's single and a computer software consultant with a college degree. He feels that one of the reasons for his success is that he continually updates his knowledge by taking classes at the local college in various areas related to software design and information technology. This year, he spent $2,000 on course tuition and fees. In order to qualify for the lifetime learning credit, again, we know that there's a maximum of $10,000 for qualified expenses. There's a statutory percentage of 20%. However, there is a phase out. So for taxpayers that are single, head of household, qualifying widower, if their taxable income is between $80,000 and $90,000, there's a phase out. For married taxpayers, there's a phase out range between $160,000 to $180,000. So based on this information, we need to determine how much will Jasper be eligible to claim. So the maximum amount is $90,000 because we know for single head of household or qualifying widower, the range is between $80,000 to $90,000. So $90,000 represents the maximum range for the threshold. Minus Jasper's AGI of $86,000, we see that in such case, there's going to be a reduction. So here's what's essentially going to happen. So we have the $4,000, and what we essentially need to do is divide this $4,000 by 10,000. Therefore, he can only claim 40% of the credit that he would have been eligible to claim. So how do we get that again? The maximum threshold is 90,000. Jasper's AGI is 86,000. So we determine the reduction. $4,000 divided by 10,000, which gives us 40%. So in such case, the $2,000 times the 20%, he would have been able to claim $400 if his AGI was less than 80,000. But because his AGI is above the threshold, he can only claim 40%, which we calculated earlier. So therefore, in such case, Jasper can only claim $160,000 because his AGI is in excess and there's a phase out. B asks, if Jasper were married and supporting a spouse who is not working, how much lifetime learning credit can Jasper claim? It doesn't say anything about his adjusted gross income changing. So therefore, his income, their adjusted gross income, is far below the threshold for a married couple of $160,000 to $80,000. So therefore, we don't need to phase out anything. He spent $2,000. The statutory percentage is 20%. In such case, Jasper can claim the full $400. All right, we look at another education credit, but this one is asking us about the American Opportunity Tax Credit. Before, we looked at a question which asks us about the lifetime learning credit. So A asks, assuming Janie's parents have AGI of 172,000, what is the American Opportunity Tax Credit they can claim? Assuming Janie's parents have AGI of 75,000, what is the American Opportunity Tax Credit they can claim? So for 2023, the American Opportunity Tax Credit, it's phased out ratably for joint income returns when the income is between 160,000 to 180,000. So based on this, we essentially need to determine how much can they claim. Janie graduates from high school in 2023, enrolls in college for the fall. Her parents, they file a joint return. They paid $4,000 for her tuition and fees. So in order for us to determine the amount, it will be as follows. So we factor in their income, and it says adjusted gross income is 172,000. Then from there, we factor in the minimum threshold, which is 160,000. So we see that it exceeds income or exceeds the threshold by $12,000. And we know that the range for a married filing joint couple is 160,000 to 180,000. So there's a phase out range of 20,000. So what we do is we divide this $12,000, the excess of the AGI above, and let's see if the amounts are in the book. It might actually be there, so you can actually kind of also see the numbers. All right, so it doesn't seem to show us the numbers. All right, yeah, it doesn't show us the numbers, but one of the key things is, again, once you're preparing the return, the information is essentially going to be automatically generated in a computer, but just having like a understanding of how it works, that will help you to advise the taxpayer. So again, the key phase out range is the 172,000, their AGI, minus the minimum threshold of 160. We divide it by the total phase-out range. And for married individuals, the phase-out range is between 160,000 to 180,000. So that's a $20,000 difference. So we see it's 60,000. And then now what we do is we multiply that amount by the maximum that can be claimed, which is 2,500. So that gives us our reduction amount, the maximum amount that can be claimed. But because of the excess income, the 172,000 minus the 160, which is 12,000 divided by 20,000, that lets us know that 60% of the allowable American Opportunity Credit is going to be excluded. So $1,500 cannot be claimed because their AGI has phased out. So $2,500 represents the maximum amount. Because their income exceeds the threshold, $1,500 is not allowed. Therefore, they can only claim $1,000. Now, in this case, assuming Janie's parents have an AGI of 75,000, we know that for a married filing joint couple, the range is between 160,000 to 180,000. Janie's parents' AGI is way below the threshold. Therefore, they can claim the full 2,500. And we know that the first $2,000 is 100%, and then the next $2,000 is based on 25%. So Janie's parents can claim the full $2,500. For this next question, we're looking at the child independent care credit. It says Raheem and Jean, they're married. They have 4-year-old twins. Jean is going to school full-time for 9 months of the year, and Raheem earns $45,000. The twins are in daycare, so Jean can go to school while Raheem works, and the cost of the daycare is $10,000. So whenever taxpayers have AGI of less than 15,000, as we can see here, the applicable percentage is 35%, and depending as their income increases, the percentage decreases, and the lowest amount is 20%. So here we see they earn 45,000. So at the maximum threshold, therefore, 20%. And now we ultimately need to determine, well, okay, how much can be claimed? In order to claim the credit, there's a few key things to keep in mind. The maximum amount of qualifying expenses is applied to $3,000 for one dependent and $6,000 for 2 or more. So yes, the problem says they paid $10,000, but the maximum for 2 or more dependents is $6,000. So we're going to use that fact pattern. In addition, in order to claim the credit, the taxpayer and the spouse, if filing jointly, they must have earned income during the year. If the spouse is full-time student, as we can see in this case, Jean goes to school full-time, his or her income, or her income in this case, is $250 and at least $500 if there's 9 or more, and the credit cannot be more than the earned income for the year, or the smaller of the taxpayer or the spouse's earned income. So because there's 2 children in this case, Jean is able, it says that she was in school for, I believe it was 9 months. Yes, perfect. So 500 times 9 months. So therefore, Jean's income is essentially considered $4,500. So the credit is going to be calculated as $4,500, right? We take the lesser of the two. For 2 children, the maximum expense will be $6,000, but because Jean is in school full-time and she's considered to have $500 of income each month, there's an income limitation in this case of $4,500. So therefore, because of this limitation, it will be $4,500 multiplied by 20%. Therefore, the maximum child independent care that Raheem and Jean can claim is $900. And obviously, there's a lot of nuance with this problem. So some key things to keep in mind is that based on the income, 15,000 or less, the applicable percentage is 35%. Once they earn over 43,000, the maximum percentage is 20%. But there's some key things to keep in mind. They must file jointly. In addition, if one of the spouses is in school full-time, if there's 1 child, it's considered that they earn $250 per month or $500 if there's two or more children. And the credit would be based on the lesser of the two. The smaller of the taxpayer's earned income, or the maximum qualifying expenses, which is $3,000 for one child and $6,000 for two children. This question asks us the maximum amount of expenses that qualify for the child independent care is the same for 3 dependents as it is for 2. So this is true, as we just saw in the previous problem. If you have 3 kids and you pay $20,000, doesn't matter. It is still $6,000, $3,000 for one child, $6,000 for 2 or more children. Next, it asks us, what is Rivers' premium tax credit? States Philip and Nadine Rivers are married with 2 dependent children. The family has household income of $51,200 in 2023. They paid $11,000 for health care for the year through the healthcare exchange. A designated silver plan would have cost $9,800, and the poverty level for a family of 4 is $27,750. The applicable percentage is 1.40. What is Rivers' premium tax credit? So in order for us to determine this information, we need to consider, all right, what percentage are they of the federal poverty level? So in order for us to determine that, we look at the family household income of $51,200 divided by the poverty level for a family of 4, which is $27,750. And we see that rounded, we get 185% of the federal poverty level. So based on that, it lets us know that the applicable percentage is 1.40. So with that being said, we consider the income 51,200 times the 1.40. What's 1%? Give me a second. 51,200 times 0.0140. All right, and that gives us $716.80. So if we round it, that's $717 if we round it. So it lets us know here that a designated silver plan would have cost $9,800. So in order to determine the premium tax credit, it would be the $9,800 minus this amount that we just calculated based on their income in the applicable percentage, which gave us 717 rounded. So the correct answer is 9,800 minus 717. So Rivers' premium tax credit is 9,083. All right. Here it asks us, which of the following is a requirement to claim an earned income credit? At least one child claimed as a dependent? No, because even if an individual doesn't have a child, they can still get EIC. At least $100 of earned income? No. U.S. citizenship or resident alien status? True. Income tax withheld? No, that is not a requirement. So C is the correct answer. This brings us to our last question. It's asking us about the American Opportunity Tax Credit and the credit amount available. And as we know, the American Opportunity Tax Credit, it's an education credit, helps qualifying low-income, middle-class individuals because higher education can be expensive. So as it relates to the maximum credit, American Opportunity Credit is 100% of the first $2,000 of tuition and fees plus 25% of the next 2,000. So B is our correct answer. So there's lots of tax credits, as we saw in this chapter. There's even some tax credits that were not discussed. Some of these you'll see in a profession, some you won't. Again, it ultimately depends on your client base. If you're dealing with high net worth clients, you'll probably almost never see the earned income credit. So there's just some things that you will see in a profession, some things you won't, but it helps to understand. One of the key things to walk away with from this chapter is that credits represent a direct reduction of tax liability versus a deduction where it represents a deduction to taxable income. And in order to determine the tax savings, you ultimately need to multiply it by the individual's marginal tax rate.